This is Agriculture Today. I'm Samantha Bennett with the K-State Radio Network. And today on this Tuesday's program, we have senior economist Guy Allen from the International Grains Program here at K-State. He provides producers with an in-depth look at the commodities market on a global scale by analyzing the latest WASDE report. He specifically gives valuable details on the current world wheat market and what that means for us here in the United States. He additionally provides information on the strengthening of the U.S. dollar and the volatility of the current global freight market. Also ahead on this week's Milk Line segment, K-State dairy specialist Mike Brouk discusses the importance of sustaining milk flow off the dairy farm this summer and management strategies to help do exactly that. All that and more ahead on Agriculture Today. This is Agriculture Today. I'm Samantha Bennett with the K-State Radio Network. On this Tuesday, we are going to be covering the World Agricultural Supply and Demand Estimates, otherwise known as the WASDE Report. To cover that topic, we have today with us Guy Allen, senior economist with the International Grains Programs here at Kansas State University. So, Guy, thank you for being with us today.
Good to be here, Samantha.
We're going to be covering the very important WASDE report, so looking at some international trade numbers and economic data. So let's start with some of those commodities that I know producers first and foremost want to hear about.
Well, we might start off with wheat. We'll look at the WASDE from the international trade perspective on that. We'll walk through wheat and then probably take a look at coarse grains and the oilseed complex.
Excellent. Let's do exactly that then. Let's start with those wheat markets.
Not too many surprises across the whole WASDE report, and the markets really didn't respond too dramatically to it. World wheat production down just to 1.5 million metric tons at 774 million metric tons. That's below last year's record crop of 779 million metric tons, but still a good number. We might walk through some of the changes of that production number. They're the largest wheat producer in the world. Their number came in steady at about 135 million metric tons. So China's number came in pretty much steady compared to May. Came in at about 135 million metric tons compared to 137 million metric tons last year. Another big wheat producer out there that we're watching quite closely is India. They came in at 106 million metric tons, down 2.5 million from the previous month's report and 3.6 million tons below last year. Some positive changes. Australia's production came in at about 30 million metric tons. That's about where their local ABARE put it last week as well. They're expecting to have a very good year, probably their fourth largest year. I think it might even be their third largest year, following their largest crop and their second largest crop in the last 2 years. Quite a turnaround from the drought. So they're quite optimistic on wheat production there in Australia. Their biggest challenge is going to be their supply chain restrictions and just their export capacity. And I think their export volumes are sort of booked out all the way till first quarter of 2023. Canadian production is up following the drought last year. It was unchanged from last month at 33 million metric tons. That's up from last year's 24 million metric tons on that drought-affected crop there. Now, Russia, being the largest wheat exporter, they're expected to have a near-record crop of 81 million metric tons with record exports of 40 million metric tons, which is the highest ever. That's up 1 million metric tons from May and up 7 million metric tons from last year.
So not a bad year for wheat so far.
Well, we've got good production, but we also have very strong demand, and we've seen wheat stocks tighten up enough that, as I've said for some time now, we can't afford to price wheat into that feed ration. It's going to stay at a good premium to corn and other feed grains, and we're just running pretty close to the wind on that. And I continue to think corn's going to be the big driver on that.
Speaking of corn, let's get into those corn markets. What did the WASDE report show in terms of corn?
Yeah, corn, really not too many changes to highlight there. Global coarse grains outputs up 3.3 million metric tons from last month. and 5.1 million tons higher than last year, as that came in at 1,479 million metric tons. One of the key drivers of that increase is the Ukraine's is getting more corn planted than what we expected. The challenge for the Ukraine is going to be their capacity to actually move that corn or that grain to market, as that unrest and that situation between Russia and the Ukraine continues to hang over those whole Black Sea markets and that whole export supply chain.
Sure, and there's some implications there for Ukraine, too, because of that situation, right? We're thinking China might be making some changes as a result.
Yeah, China's used to buy a significant volume of wheat, corn, and oil seeds from that Black Sea area. And now with the shipping challenges there, they're aggressively seeking alternative supplies. Just last week with Brazil, they signed an agreement to make it a bit easier to import a number of grain types from Brazil. And China's not the only country looking to do that. A lot of countries are seeking alternative supplies, and that's really having an impact on the ocean freight markets, which we'll talk about a bit later.
And continuing on with our commodities, we're going to talk a little bit about oil seeds.
Yeah, oil seeds really pretty much a non-event there. We had slightly higher production in both Brazil and Argentina, and really no changes into the imports. China imports were pretty much unchanged, 92 million metric tons for this year, 99 million tons for next year. China's the key buyer. They import nearly two-thirds of global oilseed trade goes to China. And again, the big thing hanging over China is just that African swine fever situation and what is their livestock demand. But the other significant thing that's happening in China is their COVID lockdown. Shanghai's been locked down for some time, and they've recently sort of loosened it up. But there's 40 other major cities that are locked down, and that's really having an impact on that domestic demand for meat and foodstuffs.
So in terms of palm oil, what can we kind of expect for those markets coming up?
Well, the big driver in this whole oilseed complex has been the vegetable oil side of it. Used to be, meal was the big driver, and we always had a surplus capacity for oil. But with this recent demand that we've seen coming from the energy sector for biofuels and biodiesel, we've seen oil prices just remain historically strong. That in the wake of sort of waning palm oil production. And we've seen some export restrictions put on by Indonesia. They've sort of loosened that up. The thing we need to remember about palm oil, a palm oil tree, once it's planted, is in production for about 20 to 25 years. So it's not like soybeans where you can change the crop every year, but once it's in production, you continue to produce it. And the trade sort of anticipated that loosening of export supplies because basically they were running out of places to store the palm oil.
In terms of commodities, anything else we should know about this market?
Well, might focus a little bit on Australia, one of my favorite places there. ABARE came out with their report last week. ABARE's forecasting a fourth largest winter crop production on record. They're forecasting 3.3 million metric tons of barley, 30.3 million metric tons of wheat. Sorghum production is expected to be the second largest ever at 5.6 million metric tons, and I think a lot of that shift in acreage into canola has been driven by the attractive oilseed price, as well as the Chinese embargo on, or tariff, 80% tariff on barley out of Australia has really seen barley acres start to wane a bit the last couple of years.
Favorable weather conditions have been of benefit to Australia for sure.
Yeah, we say down there, like everywhere, rain makes grain, and they've had another third season in a row of a very good start to the season. A lot of areas which usually don't get planted in the western edge of the eastern grain belt will be planted this year. So I remain optimistic that they'll probably come in slightly higher than what the current ABARE numbers show. Their summer crops are just coming off. Their summer crops of sorghum and cotton, their primary crops, are going to be a record 5.5 million metric tons. Sorghum makes up about half of that at 2.7 million tons. And the export of that sorghum coming out of Australia at the moment is keeping a bit of pressure on U.S. sorghum prices at the moment, as we've seen sorghum values sort of fall back a bit relative to corn.
China being a major contributor to that scenario there.
Yeah, the last 2 years we've seen probably 95% of U.S. production of grain sorghum move to China, driven primarily by that domestic market. And I think it's hard to know for sure, but probably about two-thirds of that's going in the domestic Baijiu market. which is keeping prices very, very strong and at a good premium to corn for the last 2 years.
In terms of economic drivers, is there anything else producers should probably be aware of in terms of the market right now?
One thing I sort of want to highlight, and you're starting to see it come to town here, is with the Black Sea effectively being shut down, keep in mind about just under a third of the world wheat trade comes out of the Black Sea, which is a significant volume when it comes to trade. So if you're an importing country that relies on imported tons for your food supply, it's becoming a bit of a precarious situation. So we're seeing countries not only like China, but Egypt, a lot of countries through that Middle East area, North Africa, who have relied on Black Sea grain and oilseeds, are now looking to other origins and places to secure their supplies from. We mentioned China last week, improving their trade arrangements with Brazil, but we're also seeing places like Egypt and Turkey and a number of other countries having a pretty hard look on where they can secure their supplies from. And that's having an impact, one, on their prices because they're having to pay higher freight rates to get there, and we're going to talk about that in a minute here on freight and transportation, but also increased cost. And with the high dollar, and it's making things very, very expensive for a lot of these importers. Which
in terms always makes it more expensive for consumers as well, which is always unfortunate in terms of food security situations. That just about does it for our coverage on the World Agricultural Supply and Demand Estimates, otherwise known as the WASDE Report. That was Guy Allen, senior economist with the International Grains Program here at Kansas State University. Here shortly, we'll be back with more in terms of what producers should know about international trade, markets, and important facts on volatility within those markets. That and more ahead on Agriculture Today. This is Agriculture Today with Samantha Bennett from the K-State Radio Network. We're back now with Guy Allen of the International Grains Programs. He's a senior economist here at K-State. So, Guy, now that we've just about covered all of the data from the WASDE report, let's talk a bit more about that macro scale of the market that we're dealing with right now.
Yeah, move away from the WASDE a bit into some more macroeconomic issues. Sort of two things that I track is one is the Aussie dollar, the U.S. dollar and the exchange rate, which has a big impact on U.S. commodity prices and then transportation and freight. But just this past week, we saw significant strength in that U.S. dollar index, particularly in the wake of the May CPI announcement when it was at a new 40-year high, came in at 8.6% inflation, which was notably higher than the market had anticipated. And sort of giving a sign that I don't think this inflationary situation is going to end anytime soon. I think it's going to be a bit of a long haul here. But it gave further support to the speculation that the Fed's going to continue to raise interest rates, probably a bit more than what we expected for a bit longer. I think we're expecting a 0.5% raise in July again, and some people are now speculating it could even be 0.75%. And look, we're just not going to solve this inflationary situation until we get interest rates higher than the inflation rate. So it continues to be a real concern there. Also, in the wake of that, we saw gold and silver prices higher there as well.
Sure. So in terms of those tuning in that may not be familiar with the dollar index that we're talking about, what's so significant when it comes to the strengthening of that for the U.S.?
Well, every time our U.S. dollar goes up relative to other currencies, it just makes anything you're buying from the U.S. Quite a bit more expensive. Now, if you're buying imported goods, a stronger dollar makes imported goods cheaper. But if you're agricultural producers of commodity, whether it's grain, oilseeds, meat, whatever it might be, a strong U.S. dollar, we need to start then lowering our prices to remain competitive in the world. The example I like to use, looking at Australia and the wheat market, if the U.S. dollar is up against the Aussie, all of a sudden we need to discount our prices a bit more to stay competitive with other competing origins out there in the world. And quite frequently, and most of last week, we saw commodity prices continue to weaken through the week as on the back of that strengthening U.S. dollar.
You mentioned those interest rates rising as well, and as a result of that, we can expect what in terms of demand?
Yeah, that's the challenge with an inflationary situation as we're seeing here now. The Fed's going to have to raise interest rates in order to get inflation under control. Inflation is just not a good situation for anyone. But if you raise your interest rates relative to other currencies, it just makes your currency more value. So that anticipation and an increase of interest rates, it's sort of a double whammy there. It's going to add continuing support for a strengthening U.S. dollar.
And then the major highlight that we also wanted to talk about today is the freight market, some of the volatility that we're seeing in that. What are some concerns there?
Yeah, I quite frequently talk about ocean freight. Again, it's a significant component of the price equation if you're an importer. There's a lot of other origins out there that are quite a bit closer to those key markets, one of which we talk about is that Black Sea origin. And a lot of those significant importing countries like Egypt being the world's largest wheat importer is pretty adjacent to the Black Sea. Now, all of a sudden, if the Black Sea isn't a significant source of their commodities, wheat and oilseeds particularly, they're going to have to go a bit farther to secure that. You know, they've been looking at India. They've been looking at some other origins there as well. We keep hoping they'll come back to the U.S., but it's basically just a freight spread. If we look at volatility on world ocean freight over the last 2 years or since COVID, we've seen significant volatility. In the initial wake of COVID, we saw that Baltic Dry freight index drop down to below 500 points, which is, I don't know if it's the lowest level ever, but it's the lowest it's been in a long time. Then, surprisingly, we saw demand kick back in, probably more so in the container freight situation as everybody stayed home and bought something online, and we had to get that delivered from China. But we also saw relatively good strength in bulk dry commodities, which isn't only grain. Coal and iron ore are your two major dry bulk commodities. Then last year, about October, we saw that rally back up to over 5,600 points. Which was the highest it had been in 14 years since the GFC. It then fell back down to lower levels, and just this past February it rose back above 3,000 points, and then since last month it's weakened again, and we're down to about just above 2,400 points this past week. Now, this volatility in freight's been driven primarily, as you can expect, by fuel prices. Mm-hmm. You know, your biggest component of the variable cost in transportation is fuel. But a key thing is what I refer to as ton miles. And as we were talking earlier, if you're China, if you're Egypt, if you're any importing country and you can't secure your supplies from the point of origin closest by, you have to go a bit further. So if you're Egypt and now having to procure the grain from India or ultimately from the U.S., you know, that's 3 to 5 times further, and it takes significantly more equipment and bottoms or ships, as we refer to it, to transport those goods. So that has lent some support to it. But I think the weakness that we've seen in the past couple weeks is starting to be a symptom of what I would call demand destruction. We've seen that prices are high enough now, and a lot of these countries, people just are starting to do without.
Sure. And when we talk about the importance of the history of this market, so what is the reasoning why we watch this market so closely?
Well, it is a big driver of ultimately our export prices of grain, and that reflects back to the farm gate pretty quick. Mm-hmm. You know, the market reacts pretty much immediately on changes on ocean freight. And while as a farmer here in Kansas or anywhere in the U.S., we understand the cost of transportation from farm gate to the country elevator, even from the country elevator to its end point. A lot of times what's driving ocean freight sort of gets overlooked, and we don't always see the impact of that, particularly as our export markets provide the footing or the foundation for commodity pricing across the grain belts.
Sure. And are we seeing some similarities in terms of what the market's doing to past major events, or?
Well, it's a lot of these macro issues, the strength in the dollar, the disruption in the supply chain, first with COVID, then with the Black Sea situation, has a lot of these ocean freight guys just scratching their head and becoming quite frustrated. One day it's moving one way, the next day it's moving the other, and it's quite challenging across that whole bulk dry freight transportation sector. In the wake of that, over the last 5-6 years, we've also seen continued consolidation in the industry there as well, which is presenting its own challenges. But as trade flows change and supply chains evolve and move with relative pricing, your transportation sector has to adjust. And ocean freight is a very capital-intensive industry. Significant investment in a ship and ship loading facilities, and you need to see sufficient returns over a long period of time. Your average life of your ocean vessel is probably 20, 25 years or better before you make that investment and secure that. So you just don't run out and buy a dry bulk carrier or Panamax like you do a new grain truck even. So it's a significant investment.
Sure. So definitely not an industry that you see quick turnarounds in, for sure.
That's for sure. That's for sure. And the rising interest rates and that cost of investment is just raising that hurdle for what sort of returns on your investment that you need. And this high interest rate environment just and we're going to see more of that, just makes investment in sort of those long-term assets a bit more challenging.
Absolutely. So, Guy, thank you first and foremost for spending some time with us this afternoon to discuss these market reports and some things for producers to keep an eye on. If they're looking for more information in terms of world economics, where can they find that?
Well, you can go to agmanager.com. Here, and these reports you'll find there in a bit more detail. I'd also encourage you can follow me on IGP Guy 1 on Twitter, as well as I'd encourage you to go to our market information part of our website at DTN IGP, and that has the latest daily news and market quotes.
Well, that's it on markets today. Thank you so much, Guy, for being here.
Thank you.
Like I said, that wraps up today, but don't go too far, because if you're looking to find that more information that was just shared with you from Guy, you can find all of those websites linked in our description today of our podcast. So if you want to go to Ag Manager, Guy's Twitter, or the DTN IGP website, you can find all of that in the show notes of this episode. All of that can be found on our website, agtoday.net. Once we get back after the break, we'll be back with our Milk Line segment and more from Mike Brouk. Stay tuned for more from Agriculture Today from the K-State Radio Network. To round out this Tuesday programming, we have our final segment, Milk Lines with Mike Brouk. Take it away, Mike.
Today I'd like to visit with our Kansas dairy producers concerning taking advantage of record milk prices. As the June milk price for Class 1 was announced, we hit a new record, almost $28 a hundredweight. That includes a $2 differential for the central order. As we think about moving throughout the summer, we're going to probably see at least level prices, if not possibly a little bit higher when it comes to milk. So, in the face of higher feed prices, milk flow off your farm is going to be very, very important. So how do we sustain milk flow this summer? Here's my list of 5 things that you really need to consider on your dairy. The first is heat stress. We know that heat stress can reduce milk production in our herd by 10 to 15 pounds per cow per day. Also remember that you need to be cooling dry cows and pre-fresh cows as well, as that has a significant impact on their milk yield in the next lactation. Second thing to consider is your feeding systems. Number 1, make sure that we do not have feed that's heating in the bunk, secondary fermentation, and reducing dry matter intakes. Remember that a pound of dry matter intake is equal to 3 pounds of milk. So this summer, that's going to be very, very important to your bottom line. Third, make sure that you're consulting with your nutritionist to make adjustments as dry matter intakes changes during the summer. We know we'll have lower dry matter intake, so we need to make adjustments to our rations. Those adjustments should have already started, but need to continue throughout the summer. Fourth, flies. This can be a major issue for your cows, as well as the people working on your dairy. Fly control is going to be very important in maintaining milk production. Again, flies can generally reduce milk production in a herd anywhere from 3 to 5 pounds. So trying to keep on top of the fly control issues on your dairy is, again, very important to your financial success this summer. And then finally, lameness. We know that during the summer we tend to have a little bit more trouble with lame cows. Keeping on top of that will increase their milk production and increase the overall profitability of your dairy herd. Again, lame cows generally give 15 to 20 pounds less than their herd's mates. I think if you keep these 5 things in order and pay attention to them during the summer, you can maintain a higher level of milk production on your farm, and that should allow you to take advantage of some record milk prices. This is Mike Brouk with K-State Research and Extension.
Thank you, Mike, for that milk line segment. And while we have a minute, here's the latest Kansas crop progress and condition report. According to the USDA's National Agricultural Statistics Service, topsoil moisture supplies rated 13% very short, 16% short, 56% adequate, and 15% surplus. Subsoil moisture supplies rated 18% very short, 20% short, 53% adequate, and 9% surplus. Winter wheat condition rated 17% very poor, 24% poor, 33% fair, 24% good, and 2% excellent. Winter wheat coloring was 81%, ahead of 75% last year, and near 78% for the 5-year average. Mature was 31%, ahead of 16% last year and 25% average. Harvested was 2%. Corn conditions rated 2% very poor, 7% poor, 33% fair, 48% good, and 10% excellent. Corn planted was 96%, near the 95% last year, and equal to average. Our merged was 83%. Soybean condition rated 1% very poor, 6% poor, 31% fair, 54% good, and 8% excellent. Soybeans planted was 68%. That's behind the 80% of last year and the 79% average. Emerged was 55%. Sorghum condition rated 1% very poor, 5% poor, 39% fair, 52% good, and 3% excellent. Sorghum planted was 54%, near the 56% last year and the 58% average. Pasture and range conditions rated 11% poor, 16% poor, 32% fair, and 36% good, and 5% excellent. You'll hear more from us tomorrow on Wednesday. That's it for Agriculture Today. I'm Samantha Bennett with the K-State Radio Network.